investor biases were random, then in the share market we might think they might all offset each other and there'd be no impact. However, investor biases are not random, and they can create systematic distortions that savvy investors can take advantage of. Hi, I'm Simon Russell. I'm the founder of Behavioural Finance Australia. This is the fourth in a series of videos which are intended to take insights from the field of behavioural finance and make them relevant and applicable for individual share investors. Now in this video we're going to be talking about how other investors' biases can create distortions in the marketplace and how savvy investors can use those distortions and insights about people's biases to position their portfolios to take advantage of some of those effects. Now at the end of the last video I asked you a question, which was, which animal's brain does the human brain most resemble? Is it that of the lizard, the cat, or the monkey? Now of course in aggregate it's the monkey. The human brain most resembles the monkey and other animals in sort of the primate grouping. But the point of this question really was to highlight how surprisingly similar parts of the human brain are to those other animals, to the lizard and also the cat. In fact, you can think of the brain as being comprised of three broad parts. You've got the part of the lizard, on top of which is the mammal, the cat, and then the more complicated sort of neocortex part on top. So the lizard part, which is the primitive part of the brain, which evolved many millions of years ago, is involved in very basic processes. So this is the part of the brain that will keep your heart pumping, for example. It's also involved in what people affectionately referred to as the 4 Fs, which are feeding, fighting, fleeing, and fornicating. So this is the lizard brain, which is the base of the brain, near the brain stem. Now on top of that you've got the mammalian brain, and this is the part that resembles the brain of a cat. And the part of the brain that's on top of the lizard brain, the cat part of the brain, the mammalian brain, is responsible for more complex processes such as emotions, for example. So when we talk about fear and greed in the marketplace, it's this part of the brain that we have to thank for that. Now on top of the mammalian brain you've then got the neocortex, the part of the brain that has most recently evolved, and it sort of looks like someone's taken a little baby blanket and sort of stuffed it inside your skull and all wrinkled up. That's what it looks like when you view images of it, and it almost looks like an afterthought. And actually, from an evolutionary perspective, it is an afterthought. It's evolved much more recently. Although having said that, recently still means that actually it's pretty much unchanged from the types of brains that our Stone Age ancestors were carrying around inside their skulls. But this neocortex is the bit that's involved in conscious analytical processing. This is the bit that we're consciously aware of. Now, what can we take from this characterization of the human brain to help us with our investment decisions? Well, the main point here is that the majority of our brain, which is the lizard and the mammalian parts of the brain, that's the majority of our brain, and those parts of the brain operate largely beyond our conscious awareness. They operate beyond our conscious awareness, but they can have significant implications for the types of decisions that are relevant in the investment context. So this characterization of the brain is useful because if we can better understand what's going on in those subconscious parts of the brain, we can see how they might influence our investment choices and start to think about how we might be able to capture those benefits. So let me give you two examples about how this applies in investment context. Firstly, when you think about that mammalian part of the brain where emotions reside, well, that can have an impact on us because what we can tend to do is to buy stocks that will just simply make us feel good. Now, of course, if you asked an investor why they've decided to buy something and why they've decided to buy a share, it's unlikely they're going to tell you because it makes me feel good. Now, that's maybe what they'll say, but it's not necessarily what the right answer is, because when you look at the research around the functioning of the brain and putting people in laboratories and giving them various different tasks with different sort of emotional connections associated with those tasks, and we can see that the emotion of what makes us feel good can significantly impact our decisions, even if those decisions are impacted beyond our awareness, even if that doesn't feel like that's what's going on. Right, so firstly we can buy stocks that make us feel good. Secondly, we should be aware of processes that our analytical brain just wasn't designed to do. So our brain was designed to help our Stone Age ancestors wandering around the savannah. It wasn't designed to perform statistical calculations and account for things like mean reversion. Now, mean reversion, for those not familiar with it, is simply the idea that if a company, for example, reports above average earnings in 1 year, maybe it's above average compared with their historical earnings or above average compared with an industry, the industry they come from, then actually on average what we should expect is in the future that earnings growth rate should revert back to the average for that company or the average for the industry. Now that's a pretty simple concept and something that most people can come to grips with pretty simply, but in the context of actual real life investment decision making it's quite difficult. Our brain doesn't naturally think about mean reversion. Our brain is naturally more likely to respond to other aspects of the decision making environment, and in particularly look at the circumstances where an investee company, a company has had above average earnings, and what tends to happen is that above average earnings is associated with an investment narrative. There's an investment story associated with it about why it's had above average earnings, what's happening with its company, the industry, the strategy, the management, for example, and therefore why we should typically expect that above average earnings to continue. So we're drawn to the narrative, the investment narrative, and tend to overlook the mean reversion. Now I'm using the word tend in these sorts of scenarios, saying tend to, because these are all averages. On average, we should expect more mean reversion. On average, things will revert to the mean. Now, that's not to say, of course, that it will always revert to the mean in these ways, because there certainly are very standout examples of cases where companies have exhibited long-term above average growth rates. But on average, we should expect that not to be the case. So if our brain is making us buy companies that make us feel good, and it's making us buy companies with a strong investment narrative around the sort of historical above average growth rates and our expectations going into the future, what can we do then to avoid some of those traps, or even take advantage of other people who are falling into those traps? Now, there are a range of approaches to doing this, and I'm not suggesting one is better than the other necessarily, but what the research shows is that often pretty simple strategies can go a long way to capturing some of these benefits. So for example, simply investing in companies that have a low price earnings ratio or a low price to book ratio is going to tend to tilt portfolios away from the companies that make us feel good and away from the companies with those higher growth expectations. Now the problem in doing that is that in creating a strategy like that, we're going to tend to be tilting our portfolio to companies that don't make us feel good, that might make us feel bad, or that have had that poor historical track record, or have got a bad investment narrative associated with them. Now, as we've discussed, that's ideal on average for an investment to be portfolio to be tilted in that way, as long as it's diversified and meets various other criteria. But from an emotional perspective, it's not going to make us feel very good. So the key challenge here is, how do we execute a strategy that risks making us feel bad, even if it is the right thing on average for an investment portfolio to be tilted in that sort of way? And that's a topic that I'll pick up in the next video, when we look at some of the strategies to overcome our own biases in capturing some of these benefits. But as I lead into the next video, let me leave you with another question, which is this. According to the biblical story, how many of each type of animal went on the ark with Moses? I'll repeat it. According to the biblical story, how many of each type of animal went on the ark with Moses? You should see the questions on the screen, and I'll come back and give you the answer in the next video.